This is a big milestone for us, and obviously it just changes the game as far as we're concerned. And not so much because of the milestone itself, but actually more because of how we came to the milestone. So if you think of the last 2.5, 3 years, a lot of VC-backed companies, especially high-growth fintech businesses, have had to cut their way to try and get to profitability. And some of those actually cut so far they went bust along the way. It's not been easy. And for Zilch, we took a different approach. We looked at this and said, let's grow our way to profitability. How do we do that? And in the last year, we've grown revenue 100% year over year. We've grown the margin 45% year over year. And what's really great is we've saved customers now $500 million in fees and interest in counting. And we've just gone past 4 million customers as well. And so all of those things have driven us sustainably to the point where we're printing profits. And we're really excited about what that means in the future for us.
I want to pick up on that industry expectation, because in the sea of voices at technology events, something that jumps up was a conversation that there is an expectation that companies get to the $100 million run rate in a short period of time. And it is actually happening a lot quicker than it used to. So there is an industry standard now where you have to get to that number quite quickly, right?
I mean, it's a race to this number. If you look at the market and you actually look at the industry a little bit wider than this, what's interesting is that if you look at the US, it takes on average between 8 to 10 years for companies to hit this mark, 100 million run rate. And if you look at the UK and Europe, that's 15 to 17 years on average, if you can believe it. So we've done this in just 4 years. Imagine what we could do with 17. And we just think that this milestone gives us the right to start imagining.
The comments you just made about the options of cutting away to profitability versus growing, it's fascinating, because if you look at the industry, in your specific industry, some of your rivals are looking at the cutting side, and that is with the use of AI. Klarna, one of the big rivals in the room, they're looking at cutting their footprint almost in half, I think, with the numbers that were suggested recently. They've also been cutting marketing spend thanks to AI. Is AI a tool, though, that helps you cut in future to produce better numbers still?
Well, I think most of our strategy is based around growth rather than cutting, as I mentioned. And so, what this shows us is that our unique model is working at scale. And so, something to remind the listeners about really is that Zilch has got a reverse bidding ad subsidized model. And so brands are bidding up commissions to get in front of our customers. And we can go and convert those sales at almost 55% click to sales. So brands really want to be in front of our high intent customers and incentivize them to go and spend with them. And that's really working hard for us. But of course, we deploy AI across the business. And what's interesting is that, Zilch is lucky in that we're quite a young company. And so when we started this business, we built it with AI and machine learning in its core. And so naturally, as we scale, we're growing the team because we had the efficiency of AI from the start. I think if you're an older business and you've been around 10 or 15, 20 years, you didn't have that luxury. So as you do roll out ML or AI in your company, you should see efficiencies in terms of the type of team that you need.
I love our conversations, by the way, so just take everything I say now as a good comeback. Your business model isn't just about getting ads in front of customers. Your business model is about charging at least 18.6% APR.
No, that's a representative APR. So I think
from 18.6% APR.
Exactly.
Right at the top of your website.
So what's really interesting we have to be clear here, and viewers need to understand this. I think we've had this conversation as well before.
And we're going to do it many times, because as you grow and grow, we're going to carry on.
And it's a great question for people to understand. A representative APR is completely different to an APR.
Yes.
So the problem is with credit card companies, as an example, any interest-bearing product, it revolves you into a position where you buy now and you pay forever, and you will pay cumulative interest on this. So if we look at compounding interest, I think Warren Buffett said it's the seventh wonder of the world, not when it's on the loan that you owe and you're repaying it.
Yeah.
Then it ain't.
How much your customers, your clients paying interest? What's an average interest rate they're paying?
So if you take all of the transactions in a year and all of the fees at the 51st percentile and divide that into this, it's a representative APR of 18.5%, which is the lowest in the market.
Yeah, so your clients are paying 18.5%.
75% of customers.
18.6, I said. Sorry, I was erroneous. 18.5.
That is all fees divided into this figure.
Yeah.
If customers shop through the app and they take advantage of absolutely no fee whatsoever. And it's important to note that Zilch has also never charged a late fee to date.